Hello, everybody. Good evening. Welcome to our investors Kopitiam. It's so fast. It's already at the weekend. We are Friday. Looking at the number of cases of new cases in COVID, we're probably going to stay. Of course, the for the MCO is until the 14th of April. Hopefully, it's not going to be extended. But looking at things, Singapore just actually started. It's going to start actually the MCO on next week, Tuesday or Wednesday, if I'm not mistaken. Right. So we don't know yet. Until the 10th of April, we will know whether it's going to be extended or not. So don't worry, we are still here with you guys at 8 p.m. every single night. Be with you. Although we cannot have copy time together or real copy together, but virtually lah. So just get your copy ready. All right. Yeah, today we got something interesting from you because we have actually read, some of the paper. I think is one on the Age 2 days ago that talks about, whether good dividend yielding stocks or dividend paying stocks will be a good time to look at during times of crisis. So that's what they've been talking about. So today we want to discuss about this based on data. Right, we are always data driven. We look at data to make sure that we don't just say things now, right? So we want to look at the data and see whether this is true or not. Whether we can look at dividend yielding stocks because prices now have gone very low. There are definitely many stocks that has very good dividend yields currently, right? But we have to remember that this is actually a rolling or a trailing dividend, right? The one that we see right now because it's basically based on the financials on the previous financial statements, all right? So the question now is, which companies right now is able to actually continue to pay dividends? So this is what we wanna discuss. All right. So before that, let's take a look at a market summary today. Faiz, can you just put my screen up? All right. So for those who do not have our equities tracker platform, we are actually giving out a free access to our platform where you are able to access financial data for public listed companies in Bursa Malaysia. Please WhatsApp to our number that is stated down there, 603-8408-2070, to get a free access to the platform until the 30th of April. All right. And it's also good to download now because Alvin will also show you how you can actually look for good fundamental stocks and also companies that pay dividends. Right, you can see how you can actually filter out company that pay dividends. So he's going to show you later on, and we are also going to put up videos, all right, tutorial videos on our equities tracker platform very soon on our Facebook page. So do check out our Facebook page. The videos will be out very soon. All right. So WhatsApp us at 8408-2070. Now, this is our performance today. Market is not really doing that much. The KLCI has only gone down to 0.25%, and most of the markets are quite mixed. Right? You look at the SET, which is Thailand, Indonesia, and Korea. They have actually gone. The biggest gainer is actually the Indonesian market, Jakarta Stock Exchange. Right, it had gone up 2% today. The biggest loser is actually Singapore, and I guess it's got to do with the recent the recent announcement by Singapore's PM, right? Lee Hsien Loong, which basically he announced the MCO or the lockdown in Singapore, and that's I think one of the reasons why the market actually fell quite sharply today, right? And Hang Seng has gone down a bit. Shanghai has gone down a bit. Nikkei has gone up, so it's quite mixed lah in the region. Right, I'll show you the chart later on to show you how our market is performing in the past 1 week. Now the good news is oil prices has gone up. Right, for the past 2 days has gone up quite sharply. I'll show you the charts in the short while. It's now at $26, 26.5 or 26 and a half. This is WTI crude, right? CPO prices has gone down. Of course, with all these lockdowns, the demand will be low, and a lot of plantation companies are unable to also produce. For example, like Sabah, they are still don't allow the producers to actually produce palm oil currently, right? So palm oil prices has come down. So I'll show you the chart as well later on. So this is what happened in the market today, right? We have 309 gainers, 440 losers, and 379 unchanged. So the market strength is weak because only 16.1% are gainers, 22.9% or 23% are decliners. All right. The counters traded is 58.8%. That means there's 41%, 41.2% not traded in the market today. Trading volume is quite high. I think there's actually a struggle because if you look at the chart here, you don't see much movement, right? So there's actually a struggle between the buyers and the sellers, and the market has been behaving like this in the past 1 week. So you look at the right hand side of the chart on the red box over there, you see that after rebounding 2 weeks ago, market is starting to consolidate or moving sideways. There's not much movement over here. And so what is important here is what's going to happen after this consolidation, right? Whether it's going to climb back above the 30-day moving average, right? The 30-day average, KLCI is right now below the 30-day average, which says that it's now in a downtrend in the short term. So in order for it to go at least turn into an uptrend, it has to break above the average. And this average currently is at 1380 points. All right. The gainers for today, these are the top gainers in terms of value, not percentage, because if you look at percentage, then you have a lot of stocks in there, which are those penny stocks. Panasonic, Pristine, Batu Kawan, TMB Tech, Euro. Euro has been going up. I'm not sure what company is this. Maybe later on, Alvin or Peter, if you know it, because I mean, the price of Euro is going up like the rate of new coronavirus cases. Right? It's quite scary, right? So the top losers are Petronas Dagangan, Nestle, Hong Leong Financial Group, and not Hong Leong Bank, Hong Leong Financial Group, Carlsberg and Heim again. The loser seems to be on the consumer side, right? This is FCPO, so you can see price has rebounded 2 weeks ago and is now back to where it was 2 weeks ago. And it's probably, if it cannot hold above 2,000 ringgit, it may come down even lower to around 1,950. This is based on the chart lah. So you look at here, the rebound, it tries to break above the average, but cannot go above it. The sellers come in again and start to push the price back down. So you're probably going to look at 1950 again if 2,000 ringgit can't hold. So quite a bearish market for CPO right now. This is USD against the ringgit. We have seen some strength last week, but this week it started to weaken again. Right, it's now at 435. When we see this kind of volatility, normally the price will start to consolidate sideways a little bit. So I guess in the next 1 or 2 weeks, the price is just, or the USD against the ringgit is probably just going to go sideways a little bit. Crude oil. This is what I mentioned about. You see, yesterday's rise was quite strong. We're looking at about 30% gain. Today, again about 5%. Now, what is interesting here is if those who know charting, there's actually a double bottom form, right, in the past 1 month that shows that there is quite strong support at $20 per barrel. All right. So we're probably going to see a rebound, and we're probably going to see a rebound at least to the short-term average, 30-day average, at about $32 which is the 30-day moving average. So that's where it's probably going to consolidate to. All right. So that's the market update for this week. Let's go back to our topic for today. Now, so it's interesting. Alvin and Peter is going to share with us now based on Alvin and Peter's experience, because we all have gone through in the 2008 financial crisis. I'm not sure whether we, in 1997 we were there. I just started in 1997. What about you, Peter? Were you already in the market in 1997 during that crisis?
1997, unfortunately, I'm still studying. I wish I'm in the market.
You're still studying? Okay. Alvin, were you there? Were you already?
No, I wasn't born yet. So.
Okay, maybe Busa.
No, actually, I was still a student. I think I was doing my A levels then. But actually, interesting. I was still tracking I was tracking the news, but I wasn't in the market. That's for sure. Yeah, I think I was 16 at that.
Maybe I need to clarify. I'm much younger than I look.
I think they say you have to put a tupi lah, then you look like what's
it's a problem. You need to clarify.
Right, because we also, of course, we have gone through the 2008 crisis, lah. All right, so we basically want to share the data that we had in 2008. Since we're talking about dividend stocks, whether it is a good time to actually look at dividend stocks currently. right? And of course, we're going to share with you some information. So, Alvin, it's over to you.
Okay. Good evening, everybody. Thank you for tuning in. It's we're back again tonight, 8 o'clock, right? Now, tonight's discussion is all going to be about dividends because I think when we chat with some of you guys actually personally text me or hit me up on my Facebook page or Instagram and send me a message, and I think that we get a lot of questions regarding is this a good time to buy dividend stocks because a lot of prices have fallen and what we're seeing today are historically they are basically looking at double digit dividends, right? It's possible based on historical numbers you can actually get double digit dividends, meaning 10%, okay, and above. Today's discussion is really about is should that be your strategy, and number two as well, how do you look for them? How do you actually look for them if that is your strategy? And I think lastly, we're going to discuss really having this strategy. To me personally, it relates to your own personal investment objective, right? So whatever I'm going to show you today, please take note, this is not investment advice. I'm just purely hoping to be here to add value to you, that you become a more informed, data-driven investor. Okay, so I'm gonna flip to our website. I'm going to give you guys an idea how you're actually going to start, and this is going to be the basis of our discussion, right? Again, if you haven't set up an account, please send us a message 603-8408-2070. After 14 days, it's seared into my head, right? 8408-2070. I will never forget the number ever, right? Just send us a WhatsApp. Our it's actually automated, so a robot will actually reply you. You just send a message, and it's all done automatically, right? All thanks to my team behind us. I know you only see three of us, but I must assure you, we have been slogging behind the back end to actually make all of this happen. So don't just thank us. Sometimes you gotta thank, please thank the whole team as well, including weekends. Yeah. Okay. So I'm actually on my screen here. So if you guys actually log on, you're gonna be, after you get your login, you're gonna log on. That's what's gonna look like. Now I'm gonna show you one way we're gonna start off on this. So we're saying, look, we want to be data driven when we start investing, meaning that you want to take all that gut feel and your feelings or your rumors out from all this. We're saying, look, let's look at it from a data point of view and say, look, can we find stocks that pay us fairly good dividends? Now, we already know that interest rates have dropped, in fact, twice in the last 3 months. Going forward, the question is, will there be at least one more drop? It is possible. I don't rule that out. It really depends on the economy. Okay. Now, so when you are faced with, say, if you have a lot of money in a fixed deposit and you're getting 2%, right? What are you gonna do, right? One option is to continue staying in fixed deposit, earning 2.5%. The other option is, look, take opportunities that, about Warren Buffett always says, be greedy when everyone is fearful and fearful when everyone's greedy. So most people right now are quite fearful if you look at the prices today. Now, so if you're fearful but you still want to be safe, now this is what we do or what we teach in some of our classes that we run. Please do check us out after the MCO is over. Now, if you look at this, what I'll do is I'll look for companies with what are called continuous or sustainable profits. That means when we do this filter, we're actually looking for stocks that have been continuously profitable for the last 10 years. They must also continuously pay dividends. Now, this is very important if you're looking at dividend stocks, because we don't want stocks to pay dividend this year, next year, then year before they don't pay. So you want consistency here, right? So it's almost like your fixed deposit. So last 10 years, they must make profit. Last 10 years, they must pay dividends. And more importantly, to fund those dividends, okay, you need to have cash flow, okay, to fund those dividends, right? So we've got 10 years, companies have been profitable last 10 years, they've paid dividends every single year for last 10 years, and they've had positive operating cash flow last 10 years. Now, so which actually going to bring us back to companies that were back in 1997, right? So we can actually look at companies that actually did still pay dividends in 97, 98. So companies that still paid dividends during a crisis, all right? Now, what I want to do today is do a dividend yield of 7%. Okay, I'm not doing double digit yet because I think 7% is in current market is quite high, considering you only get 2.5% in FD. And then click submit. Is FD now 2.5%? I don't know, guys.
No, I think it's three. It's three.
Oh, three. Okay, sorry. So you rather have 3 versus 7, right? So that's the whole idea. If you're gonna take your money from a risk-free situation, you want a higher return. I'm just gonna zoom in here for those who can't, because I know my screen is showing, but really what we're showing here are stocks here. Let's see how many stocks there are. There are a total of 43 stocks, right? Now these stocks are all sorted alphabetically, right? Okay. I know the next question is gonna come. Can I have this list? The answer is Benny. What's the answer? Can I have this list?
This list,
Yeah.
Ken, we need to reach 500 people today. 500 views.
Okay, 500 people. Okay, that's right.
So
It is
start
500
tagging your
Facebook,
friends.
right?
Please start tagging your friends right now.
Right.
Get them to
Okay. Thanks, Benny. So 500 to get this list, all right? And you know where to get it. Just send us a WhatsApp on the
On the
same
number?
number 603-8408-2070. Okay.
Once we reach 500, it will be on a WhatsApp. No 500, not on the WhatsApp.
Okay. Benny's very strict. Thank you. Right. Thanks. Okay. Okay. So now what I want to show you how to read this. Okay. Look at this. This company has been continuously profitable for the last 13 years. They paid dividends in the last 13 years, and they've had positive operating cash flow in the last 13 years, which means 2020, or let's say 2019 minus 13 years, you are looking at 2008, right? 2007, 2008. So these companies actually already paid dividends in crisis. So anything above 13 years, that means they actually continue paying dividends even during a crisis. So the latest crisis was 2008. So if you look at APM is here 20, some of them 24 years. So 2020 minus 24, you're looking at 1996, right? So since 1996, they've been continuously paying dividends, right? So you look at these numbers are a long time, right? And the whole idea of these numbers is to give you, look, you're saying now I'm not just simply buying stocks, I'm being data driven, and based on yesterday's closing price, their dividend yields is at least 7%. So let's look at the dividend yields here. 11, 8, 8, 11.96, almost 12, 11%, 7%. Wow, this is 16.5%. Okay, so we're gonna have a discussion around this, whether these numbers are actually sustainable, right? 7.6, 7.5, 7, 10%, 20%, right? So we got 20% here. What else we got? 15, 8, 7, 9, 7, 15 here, another 15%, 9%, 7. Well, we've got a 25% as well. Okay, based on yesterday's closing price, all the way up to 8%. All right. Now, actually, we dug deep, even further. Just for you guys, we actually pulled all these numbers out. So out of these 43 companies, let's look at a deeper dive, because this is only a first cut, right? Now I'm gonna go back to my slides here, so I can give you guys an idea. For those who have just joined us, don't forget, if you like what you've just seen, these accounts are free until 30th April 2020. Please send us a WhatsApp at 603-8408-2070 for your free account. Okay. Now, out of these 43 companies, now this is where we're going to start the discussion going. And please keep your questions coming. Actually, stay till the end, because we've got something very special for you, right, Benny?
Yep.
Some of you guys requested something, and we've got something for you today. We're going to stay till the end, right? So we still need to hit 500, right? We still need to hit 500.
90 more.
All right. All right, awesome. Okay, so what we've actually done is actually group all the 43 companies that we found, and we group them by sectors. So it's very easy for you. So yes, whatever you're seeing on screen right now, you can get exactly what I've just shown you. Okay, we just need to hit 500. Start tagging people. Now, actually, out of the 43 companies, 7 of them are actually REITs, right? So your question today is like, wow, REITs are so attractive. They pay dividends all the time. They're rental. So should I put, some money, buy some of these REITs, and then get this very fantastic dividends, right? On this list, minimum is 7.6%. The highest is 15.8%, right? So it's if versus 3% of FD and you're getting 15%, that's almost 5 times what you're getting at FD, right? So the question is this too good to be true, right? And we're gonna talk about that, all right? Now the next list we actually segmented it out. These are industrial products and services. Now we actually went even deeper. If you look at this, if I can move my mouse here and I can highlight to you, there are 2 companies that deals with auto parts, right? There are these companies from the healthcare and hospitality. There's also a company that does ICT or software solutions. We also have consumer electronic products, rubber manufacturing products, or concrete-based products. So although they are grouped as generally industrial product services, what Equities Tracker has actually done is actually break them down specifically into what we call 89 different subsectors. So they're even more specific, right? Now, so there are 1, 2, 3, 4, 5, 6, 7 companies in this space, all right? So you got 43 companies, a lot of companies to actually choose from. Now, this is where it gets interesting, right? We found, and I'm going to show you, got 1, 2, 3, 4, 5, 6, 7, 8, 9. On this page, there are 9 consumer products and services. They are classified under Bursa as consumer products and services, right? So you got food and beverage, you got trading, you got paper and stationery, you got tobacco companies as well. Okay, this is actually the next list. These are also all consumer products and services, right? BJ Toto, Genting, Magnum, FPI, Panami, Homeritz, Giant Corp, Lihan, and Pohuan. Okay, they are all They are all classified as consumer product services. Now, second last list almost. Now, this is where we've got 2 companies in financial services, 1 in plantation, 1 in tech, 2 in transport and logistics. 3 in transport and logistics, 2 in property, 1 in construction, and 1 in utilities. Now, actually, we break it all down into a sector of all these 43. You're gonna realize that. I'm probably not surprised, but a bulk of these companies that every year make profit, every year pay dividends, and every year have positive operating cash flow, 41% of these 43 companies actually come from consumer products and services. By far, they're largest. They're almost 50% of all stocks here, right? And this is where we're gonna have some discussions around it. Now, please take note that this list that we've done for you is very, very stringent. Okay, it's not easy for a company to pay dividends every single year. To have profit every single year and have positive operating cash flow every year. Now, when we look at history, ultimately what we want to find is predictability. How predictable are some of these companies? And really, that is going to be a point for you to decide whether you want to invest in these companies. Now, a lot of what we've just done is purely data driven. We are not, randomly picking stocks and saying, buy this, buy that. No, ultimately the decision is yours, but we want that methodology to be more data driven. Okay. As you can see, property company is only 2, construction 1, utilities 1, technology 1, plantation 1, transport logistics 3, financial services 2. Industrial products and REITs are the 2 second highest one, right? So if you have consumer REITs and industrial products, these guys form up to almost 80% of the 43 stocks that we're talking about, right? So what you can conclude from this is very simple, right? If you look at property stocks, there are not many property stocks or property developers that every year can make profit, every year got cash flow, every year pay dividends. Okay, it is tough, simply because if you look at the business by itself, it's actually very contractual based. They find a piece of land, they build it, and then what's next, right? So the continuity factor is probably a little bit harder. compared to on the complete flip side on consumer products, right? Like now, the Maggie Mee shelves are empty. Everybody needs to eat, right? So these kind of relationship types of products tend to have better recurring revenue, recurring income, therefore more stable dividends. All right. So this is just a so now if you guys have any questions, please type it in. Benny is reading up on all the questions now, and then I'm gonna pass you on to Peter. And we're gonna have a chat and probably pull out a few companies, and then hopefully answer some of the questions you guys have. All right, Benny, over to you.
All right, Peter, you have something to share first, right? Or we want to get some questions first, or maybe after Peter present. Peter, you're on mute. Your mic.
Sorry, I always forgot
Alright.
to unmute myself. Okay, I think what we can do is just want to explain to the viewers where dividends usually come from. We always tend to look at dividend on profit basis, but if you look at the slide, sorry, the previous one, Faiz, correct?
Alvin.
Yes, correct. Sorry, Elvin, sorry. Okay, this correct. Okay. So if you look at this one actually summarize what the concept of what is actually free cash flow. Free cash flow simply means what you take the company's operating cash flow, you minus the capex. So that's in a very general perspective, they get free cash flow. But in our definition, we are actually a bit more stringent. What we look at, we don't look at capex, we look at maintenance capex. There's two types of capex. Okay, capex is a short form for capital expenditure. There's actually two categories of capex. One is what we call as a maintenance capex. Maintenance capex simply means the amount of maintenance you need to spend. If you are a manufacturing company, the amount of investment you need to make to maintain your existing machineries just to sustain your earning power. Say, for instance, if you are making 100 million revenue every year, how much you need to spend to maintain your machine to ensure it continues to generate 100 million revenue. Okay. The other capital expenditure or capex actually we call expansion capex. Mean to say you buy new machineries to actually increase your earnings power. So the concept of free cash flow actually, if you take a more stringent perspective, is actually your operating cash flow minus your maintenance capex. So I'll have the next slide. So if you look at the flow, what this one means is if you look at it, at the top you actually have your cash from operation, and then you minus your maintenance capex. So then you have a free cash flow. From this free cash flow, you have two choices, or company have actually two choices. Choice number one is they will spend to actually expand their business. Therefore, they will spend it on expansion capex, which will then bring in more cash to the operation, and therefore the cycle will grow bigger and bigger. If you are talking about a company where there's no longer growth or there's very minimal growth, there is really nothing much to expand, this free cash flow will actually end up as your dividend. So this is actually where the relationship of why answer the question of why growth companies, they don't really pay much dividend, because they need to reinvest the free cash flow to grow the business. It is only usually when it comes to companies where you have reached a certain stage of growth where your growth is not as fast, or you don't really have much room for it to grow further. That's where they actually return the bulk of your free cash flow to you as dividend to you as a shareholders. Yeah. So actually the reality, if you look at dividend, the origin of dividend actually it comes from the companies having free cash flow. So the next question is, if you have a company who actually doesn't have much free cash flow, but they still keep paying you dividend, then there's only two possible sources. Either they have a lot of cash holdings in their balance sheet, or a very likelihood is maybe they are paying you through gearings or through bank borrowings, which is not a very good sign. Yeah. So that's the clarification I want to explain on the concept of dividend and free cash flow. Back to you, Benny.
All right. So I mean, of course, cash flow is one of the data or one of the criteria that we need or the company need to have before they can even look at continuing to pay dividends. So that's what we are saying, right?
Yep.
Of course, we break down the sectors. I think there's one question that talk about the slides that you presented earlier, Alvin, because there are quite a number of read counters there. All right. And knowing that because of this lockdown that we see there, do you think they are still able to give that kind of dividends moving forward? Alvin, your mic.
Thank you. That's actually a very valid question. Now, I cannot answer on all the REITs' behalf. If you look at what was happening when markets were rising up, a lot of people started moving their money into REITs to get safety and consistent dividend, because I think the misconception is this: REITs have very low volatility. I think that's from a retail's perspective. People say, yeah, let's put in the REITs because very stable. If you look at where we are today, markets have fallen. Some have fallen more than 50%. So I think that there is. So to think that they're safer just because they're property and therefore less volatile, I don't think that's true. Number one. Number two, if I bring myself to that list here, um, if you look at the REITs here today, I can't comment on all of them because I'm not a very big REIT person. But if you look at some of them, 15%, they look really, really good. But what you actually really need to do is you need to go down into their portfolio of real estate that they're in. Okay. Now, we all know that the retail sector is already very badly hit from the MCO. A lot of the tenants are saying that they want a moratorium or a discount on the rental because on they can't do business, they cannot be paying full rent. Um, we know in Singapore, I think at the end of this month, they are actually going to amend a law, or to pass a law to actually force the landlords to actually reduce by up to 50% of the tenant. Now, I'm not saying it will happen here. There's a high probability it might happen. So you must look at. If I look at, let's say, for example, Hector is, I think their strategy is suburban shopping malls, right? So their dividend is 15%. So that question here is that if they're gonna be forced to say give a moratorium of 6 months, then because this is based on last year's dividend yield, uh, it may be much lower than 15%. I'm not saying to buy this REIT, but what I'm trying to say is if you find companies that are very much based on shopping malls or commercial at this point in time, they are very very badly hit, right? The question is if you just want to hang on to them. So what I'm trying to say is that you're probably not going to get what you're going to see on the screen, 15%. You need to actually assess the situation, right? Because otherwise, if those commercial companies that tendency is all due, right? A lot of them may not renew because if the retailers don't renew the tenancy, right? So this is actually the current risk right now with a lot of the REITs that are very very exposed to how to say, commercial is a very general word, but maybe shopping malls or very retail heavy. Yeah, over to you, Benny.
All right. Okay. There's a question here from Edmund Chan. The banks. I mean, not all the banks. Some of the banks have been paying good dividends, right? Like likes of Public Bank and Hong Leong. But moving forward after on this crisis, do you think they're able to provide the dividends, and also will there be a potential for growth post after the COVID crisis?
Peter, you take it?
Okay, if you ask me, I think I'm a bit more. I think in Hokkien they call it kiasu. To me, honestly, when I said a company for me to classify as a good dividend yield, at least 4.5% or 5% and above. Honestly, to me, if there's any dividend yield that is below that level, it is not attractive enough for me for a very simple reason. As you see, if you put in FD, you get 2.5 to 3%, and that is Cantonese you say ting ting one sec, you get it there lah. So you think about it, when you go into shares, there is volatility of share price. So for the volatility of share price, for you to earn another 1 to 2% additional yield and to stomach that volatility, then the question is it worth it or not? Right? You get where I'm coming from? So if you are say, for instance, if you pick FD, you get 3%. But now if I put in this say bank, this bank where it give me a 3.8% or 4% yield, So you really have to think about it. Is it worth it? Because if you put at the 3% from FD, there is no volatility on the share price. Whereas if you just go and get a 3.8% dividend yield and you invest in the share market in the bank, you have to stomach volatility. So if you ask, in the end, is that 0.8% worth it or not? So for me personally, I would classify those good yields. For me, I'm a bit kiasu. So to me, it's like 4.55% above that, I'll say it's a good yield. So you look in the banking sector, there's only a few companies that actually give you this yield. Of course, if you top of the head, would be, of course, Maybank is one. Maybank currently, I think, close to 7%. Second is actually CIMB. But then it boils down to your CIMB. I need to rethink like this off my head. I think CIMB, yes, is around that level. But then the next question is like, I saw a lot of questions also asking the issue of sustainability. How sustainable are your earnings? I mean, this is just a personal opinion. I think if you look at among all the banks, I think Maybank has the most diversified earning base. They have got hit into a lot of bad loans before, but despite that, they are still able to generate very decent earnings because their loans are quite well diversified. So this is again not a recommendation to buy anything, but among all the banks, I would think the most sustainable dividend yield I would say is actually Maybank. Yeah.
Maybe later, Alvin, if you can, maybe if you want to show Maybank's financial performance, at least later when we look at because we also got a few shares to share, right? We want to compare one, how sustainable it is, and probably another company which also fundamentally sound but may not be sustainable. I think later Alvin will make a comparison, then you have an idea, so that when you do your homework, when you go into our Equity Striker platform, you know what to look for as well. So before we go there, we'll try to answer more questions. I think this one is directed to our own platform. It's from our top fan, DT Koi. He said that he saw the news EPF buying into YTL, and yet he saw from ET website where YTL is in the disaster list. Well, I don't know. We have disaster list. Okay, so mine to comment on EPF action and the reason why is it on our so-called disaster list.
That's a good question. Just by the way, EPF owns a lot of stocks. Just because they buy or sell something, in my personal opinion, doesn't necessarily mean it's a good or bad thing. All right. Same goes for any other funds. So I don't drive my investment decisions are not driven by what EPF or Co-op or anyone else is buying. You must first love and understand the business. I think that's more important, right? Now, why did we put it under disaster list? Now, let me define what we said disaster list, right? YTL Power were one of the stocks that we thought we bought that were undervalued, and we put into our portfolio, public portfolio that we actually share with our members. And that was a stock that we actually lost money on. And because at that point, we were very attracted to a few things. The price dropped by 50%. They were very high dividend yield. And I think the dividend yield was something like 7-8% based on historical. So this is a very good question. They had a lot of cash, and most of the debt were very long term because of utility, right? And a very, very stable business. So we're thinking, what can go wrong, right? Of course, subsequently, after we bought it, the price went down, I think, another 50%. So for us, we mark it as a disaster list. What happened was the company actually, after many years of paying dividends, they announced that they're going to stop paying dividends. So from 8% becomes 0% or double zero lah. Okay, double 0%. So that's sorry, Peter.
No, I think just to save Alvin in case he can't check into certain hotels in Malaysia, I think the disaster list means the disaster on our side. We are not saying YTL is a disaster. We are saying we make a disaster from our investment.
Yeah. So
yeah, so that's why I want to highlight. Okay, maybe just to keep the answer short.
All right. Alvin, there's a question about your slides because you're talking about dividend yields there. Is based on what price? Is it the current price?
The dividend yields that I've shown you that you can also get from a system are always based on the latest closing price. So because it's only 8 o'clock, so our website is not updated, it's actually yesterday's closing price.
Okay, so it's yesterday's closing price. We'll put a note on the slides lah.
Yes, I'll put a note on the slides. Thanks.
Okay, now next question on our platform as well is FCF. I believe it's future cash flow. Given in your database or each company in Equity Striker platform, I mean, do we have FCF.
Yes, yes. In fact, I can show you guys. If you want to have a look. Actually, in fact, Peter, we're gonna run this example, right? You want to do this
Yeah.
with the dividend? All right, cool.
Okay, why
Let's do
not we
it.
do this now? Yeah, why not we do this now?
Okay, I'll do it now.
Anyway, yeah, while you're loading, we already reached 500 views. So
Thank you. Thank you.
congratulations, guys. And
We also have 100 on YouTube, so we're actually 600 tonight. So well
wow,
done.
awesome. So, guys, I mean, if you have benefited from this, please share lah. Sharing is caring, right? In this time of in this situation currently. So just please share as many as your friends as possible. Hopefully, they are able to benefit from this, especially if they are investors. So once again, to get the slides for today, just WhatsApp us at the number 03-8408-2070. I'm not sure whether you're able to get it by tonight, but tomorrow you should be able to get it. All right. So just message 8408-2070. Okay, Alvin, you ready?
Yep. Faiz, when you're ready, can you switch to my screen? All right, cool. So what I have here is actually the 10-year financial statements. I'm sure you guys have seen it many times. Now, if you guys, I'm just curious. I know a lot of you guys are there, but if you guys want to learn how to read these numbers very quickly, even though you have no financial or accounting background, I can teach it to you guys very very quickly, right? But if you're interested, obviously not on this show because this show is about the discussion of stocks. But if you like to learn more about this, just type in learn because I'm just want to gauge what kind of interest there is. I know some people are very scared of numbers, but I can assure you they are not very difficult to learn. All right. Now, so coming to what Peter has mentioned, we talk about free cash flow. Yes, it is on our website. I'm going to zoom in for everyone's so that everyone can see. Can you see? I know it looks a bit weird, but that's because I'm zooming in. Yes, we do calculate the free cash flow from you here. So if you look at the free cash flow here, Peter, you want me to take this? You want me to just explain what you just?
Yeah. Go ahead.
Okay.
Please.
Now, if you look at Nestle, Nestle is a very interesting company, and I love to use Nestle as an example because I used to be an investor, but I have taken profit. But I still really like the stock. I think it's a great stock. Now, if you look at this number here, if I can just highlight here, this is how much profit they make in 1 year. Okay. Now, if you look at this line here, this is how much dividend they paid in 1 year. Now, you're going to see that 167, 165, 195, 180, 216, 210, 240, 235. You're going to see increasing, right? And that's why I like Nestle. Now, you can actually pretty much deduce that Nestle, whatever amount it earns, it pays out almost everything as dividends. Okay, so if you can see the dividend payout ratio here, it is 90, 100, 99, 100, 100, 97, 97, 92. Now, without data, none of this sort of predictability can come true. So it's very important to actually have historical archives, but you need to sort of learn how to utilize it, right? And again, if you guys are interested, just type in learn. I just want to know if you guys are interested. I'm happy to run a session to show you guys how to read all this. Now, that means 1 year, 10 years ago, Nestle used to pay 351 million 351 million ringgit in dividends a year. This is 656 million today as of last year, right? Now, if you look at these numbers here, this is how much dividends they pay out. If you see where it very closely relates to what Peter is saying, this is the free cash flow of Nestle every single year. So if you can see, their free cash flow 10 years ago was 380 million. They paid out they paid out 422 million, very close, right? Okay. If you see here was 368. They paid out 492. Here was 491. You realize they paid out 551. So you can actually see that they actually take the free cash flow to pay out dividends. Just to give you guys an example, what Peter was talking about. Again, you can access all this, set up a free account, WhatsApp us at 603-8408-2070. All right, just to answer that question, over to you, Benny.
All right. Yeah, because I guess there are a lot of questions about. I mean, we have already done a filter on dividend stocks, right? These are all stocks that are above 7%. you already explained earlier how to actually look for at least some consistency in their earnings and their cash flow, so that you probably have a higher probability, right? But are there any examples, for example, like the sector that there's a question here that says, out of these lists that you have given us, which sector is likely is going to go, it's going to continue to provide the kind of dividends, lah.
Benny, can I just? I know someone mentioned that. Just now Peter was talking about Maybank, and then someone mentioned that why is there no banks on this list? You have to
Mhm.
understand, before you get 7%, we got three criteria. Every year make profit, every year pay dividends, every year got positive operating cash flow. Okay, and so for some banks, it's not every year they have positive operating cash flow. Just to answer that question, right?
Right. So
Uh,
there's this additional filter, lah, not just a 7%, right?
correct.
I think maybe some of them they came in a little bit late because you were explaining this earlier just now.
Yeah.
So you have that you just mentioned, right? The 10 years of continuous profit, 10 years of continuous positive cash flow, and 10 years of continuous dividend. That was also the criteria. So you have about like 40 over stocks, right? Was it correct? 40 over?
40, 43 stocks.
Right.
43
Okay.
stocks, yes.
Okay, now this question is related to the software as well. I think people also want to know. This is from Wong Hongji. Now, this guy is trying to figure out intrinsic value. So, how can we derive intrinsic value?
I get this question all the time. Peter, you want to go first?
See, the concept of intrinsic value, I think, is a very misunderstood concept. If I will give an analogy, right? Say for instance, now you have a friend who actually have a BM5 series. Then say for instance, you want to sell for 60,000. So you are keen, but what you do is you don't know how good is it, right? So then what you usually would do is you will drive this BM to your trusted mechanic. And then you tell a mechanic, look, I have a friend who wants to sell me this BM for 60,000. Can you please help me take a look? So a mechanic will do his job, he will analyze the car, he do everything. And the final answer the mechanic was likely to give you is yes, whether is it a good buy at 60,000, right? Or is it no, it's not a good buy at 60,000. Your mechanic won't be able to tell you that this car is worth 62,231 ringgit and 20 cents. You see where I'm coming from? So likewise, when you say intrinsic value, it is not a very carved on the stone or a very hard number. It is not a target price. An intrinsic value is simply a value which, based on your understanding of the company, of the business, whether the current price or the share price is actually much lower than what you think is the real value of the company, or is the real value of the company much lower than the current share price. It just exactly like the same, like back to the same mechanic analogy. The mechanic won't be able to tell you what is the exact value of the second car you want to buy, but he is only able to tell you whether at 60,000 is it worth it to buy or is it not worth it to buy.
All right. Now, there seems to be quite a number of questions on LSoft. Number one, LSoft is paying good dividends and all that. So, question number one is, I think the list that says LSoft dividend yield is currently 19%. Basically, was from Yuan Tong asking how you actually get 19%. Number two about LSoft is, what do you think? Do you think that they can still continue to pay that dividends moving forward?
Okay. Alvin, want me to take this or?
Yeah, of course. I'll add to. Yeah, don't worry.
Okay, if you look at it as we all must understand this. All these lists are generated based on a trailing basis, on the trailing earnings, right? We must clarify this. This is not a buy list. We are not asking you to buy the 43 companies we have here. No, please. This is only a data generated. If you look at it, trade as we mentioned very earlier. To pay dividend, you need cash flow, you need earnings, right? So this is based on historical earnings which is already been delivered. So it's not likely, it's guaranteed this COVID issue will have an impact on all the earnings of all companies. I think no one will be spared. I think the only exception will be Glove. I think no one will be spared from this. So caveat is that don't invest simply based on you see this current on the base trading dividend yield is high. I'm going to invest because earnings will be affected. there will be adjustment. But what you should be looking at now is on the normalized earning. This is where having a big database, historical database, like what we have in our website, is very important. If you have a very long historical database, for instance, you have 15 years or even 20 years data on the company, what you should be doing is you should look at on average on a normal operating level. If things are on a normal basis, what is the earnings, what is the cash flow, and what is the dividend? So use that normalized dividend as your benchmark based on the current price. What is that normalized yield? And if that normalized yield is something very attractive, then we will say, yes, that's a very good investment opportunity. So we need to stress this yield is only based on last year's earnings. And likely this year, they are not like, I don't think anyone is able to continue that kind of earnings. I'm not sure if you agree, Alvin.
Yeah. maybe I show you guys a bit of data and files. If you can switch to my screen, I'm just trying to take what Peter have said and sort of I give you an idea how what we're saying. Okay, so files are we on my screen? Okay, so what I'm looking at, let's look at the latest year. Okay, so the last because audited numbers are not out yet, I'm using 2018 numbers. ℎ𝐿𝐴 did 78 million in sales and they made about 39 million in profit. Okay, now which means that it equals to 6 cents per share that they made in profit, but they paid out 7.5 cents. Okay, so very special. The total gross dividend payout was about 49 million. So they paid out everything for this year, plus they had extra cash from previous years. They paid that out. So they paid 50 million in dividends. Okay. If you look at this dividends that has happened so far in 2020, let me just double check. Is this ℎ𝐿𝐴? Yeah, okay. So you can actually use our website and find out what are the dividends that they've paid out so far. So we are not even close to what they have. Now, on top of that, if you look at the quarterly results, if you take Q4, Q3, Q2, Q1, these are not audited numbers, the total cumulative profit for 2019 is only 17 million, which means that it is less than half of what they reported. So to use those yields to say that they're going to make the same amount, that's where you need to be careful. You need to understand the business. You need to understand what industry you're in. You also need to learn how to navigate around financial numbers, if that makes sense.
Peter, you mentioned about, okay, of course, other than the gloves, probably most of the other businesses will be affected, right?
Yep.
What about essential products and services like Tenaga and telcos? Do you think they'll be affected as well in COVID? I mean, Tenaga is a monopoly. Everybody's using energy from Tenaga, so because the yield is probably currently about 6%. So do you think it's attractive? I mean, do you think they can sustain?
Okay, if I split between Tenaga and telco, I think the answer will be very different. I always find Tenaga to be a very challenging company. Again, it's a personal view. You see, when you do a business, you must either, there's two factors that is played, is your revenue and your cost, right? So if you are in the business, as a businessman, you will want to control either one. You either able to, if you cannot control the cost, you must be able to control the revenue. If you're not able to control the revenue, you must be able to control the cost. And of course, the most ideal business is you're able to control revenue and the cost. But what I'm trying to say is, for a business to sustain, you must be able to control either one of the two factors. I always think Tenaga is a very tricky business because it's a business they can't control both. Because on the revenue side, it's actually determined tariff by the government, so it's beyond their control, right? On the cost side, these are all global commodities such as coal, which again, the price is beyond their control. So you're in a business where it's very hard to control your revenue, which is determined by government, and it's very hard to control your cost, which is determined by the global prices. So that's why I always find Tenaga is very hard to predict the earnings or try to project what kind of earnings. For telcos, yes, they are known to be very steady. Their earnings have been very, very stable in that sense. But see, when it comes to take the current instance, for instance, right, a lot of telcos have been called to do national service. To provide free bandwidth for a certain period of time to increase it. So yes, their revenue will not likely be affected, but their cost will definitely be affected at this period. But of course, it won't be a plunge in earnings, but there will be an increase in cost during this kind of difficult period. Yeah, so I would say nothing is really spared. When a downturn, I think there's a common terminology when the shit hits the fan, it splatters. I don't think anybody can escape from it.
Yeah, there's also a question about what about pharmaceuticals?
Pharmaceutical. Okay. Oh yeah. I explain in another session. I keep confusing. Okay. See, Malaysia. If you look at Malaysia's pharmaceutical in a very brief manner, to sum it up, there's three categories of pharmaceutical in Malaysia. The first category we call it as the hospitals, right? There's only three listed hospitals in Malaysia, which is your IHH, your KPJ, and also your what's the one in Kota Damansara again? What's the one in Kota Damansara again? I forgot already.
Which one?
Kota Damansara. Next to Sergi.
Tropicana.
Sorry?
Used to be-
Tropicana. Yeah, TMC Medical Center. So if you look at it, technically, hospitals with COVID, without COVID, their earnings has always been very, very stable. But the biggest, of course, is IHH. But IHH, the big chunk of the earnings are coming from Turkey. So it is more of we are betting on the Turkey economy and the Turkey dynamics rather than the Malaysian dynamics. That is the first category. Second category is your drug makers, right? And there's a whole ton of them. You got Apex Healthcare, you got Potra Healthcare, you got YSP Southeast Asia, you got CCM Duo Pharma, and the list goes on. Okay, the reality is this: if you combine all the players manufacturing together, I think plus minus on the purely manufacturing side, I think it's barely 2 billion. I think it's barely $1 billion US, plus minus. I mean, max $2 billion US. But I don't think it's $2 billion US. You combine all the revenue together, right? Excluding Pharma Niaga's trading business. Don't add Pharma Niaga's trading business. I'm talking about purely drug manufacturing. So these players, they only do generic drugs, meaning the non-patented drugs. That is, unfortunately to say, I don't think Malaysia we are able to do a patented drugs, not because we can't, but you look at companies like Pfizer and Merck and whatnot, their annual R&D in patented drugs is $100 billion US per company. $100 billion US just for R&D. And as I mentioned, our revenue combined is barely $2 billion US. So that's why we are never in that space. So all the pharmaceutical company in Malaysia, drug manufacturing, we are only manufacturing generic drugs. And the growth is more like population growth, your single digit kind of steady growth, that kind. So if you expect manufacturing companies or drug pharmaceutical to give you that kind of boom suddenly, that 20-30% growth, I honestly, we have to be realistic. It's not possible in that sense, right? So that's the second category. The third category is glove, and this is where that you are really a global champion. You have all your glove players contributing 60% of the world production. So that actually gives a very sum up scenario of the health or the healthcare sector in Malaysia. Yeah.
All right, awesome. Now there are rest of the questions. I mean, it's got to do with a lot of I think on the usage of the equities tracker platform, and also I think some of them are probably still quite new in investing. They were asking questions like what is cumulative PE and so on and so forth. So guys, I just want to ask you guys a question. How many of you would like an online learning session? This completely online learning. Is not what we are doing right now. Online learning session, and also which includes the usage of equities tracker platform for free. Yeah, serious, for free. If you guys are really interested, type it down. You say you want to learn, or just put e-learning on the comment. Just put e-learning on the comment. Put it down there. If we get very good response, we're gonna do this for you guys. Since you guys have been staying with us, and we already got like 600 people actually viewing today, including YouTube. We're gonna provide it for free, but continue to watch our Facebook. We'll make an announcement soon. All right. So like our Facebook, we'll make announcements, and you should be getting a notification. So if you're interested, we'll let you know in the next 1 or 2 more days. All right. So that is our first news of the day. Second, some of you has been asking t-shirts. I mean, on the comments. Our equities. I don't have the t-shirt today because I've been wearing them for the past few days. So mine is just a black t-shirt. Maybe Alvin and Peter, you can model a bit. Yeah.
Let me clarify Benny's statement. He has been wearing for a few days, but he did wash. he did wash.
Yeah, yeah. So if you want a t-shirt, we're gonna give it for free. Okay, for free. Now, for the first person who tag their 10 friends right now on the comment section, 10, it must be 10. The first 10, the first 10. Okay, this t-shirt is valued about 80 ringgit lah. It's cotton, right? Cotton, right?
Don't tag 10, huh?
Yeah.
Don't tag
10,
10.
Don't-
You
don't
must
tag
tag 10 people.
yeah, tag 10 names, please. 10. So the first 10, we'll look at it, then we'll get in touch with you. We just need your address so that we can and your size lah, of course, right? And we'll ship them to you. All right, so that's our second announcement.
Benny, is it 10 t-shirts or just one t-shirt?
One t-shirt.
One t-shirt. Don't
Yeah.
type 10,
One t-shirt, huh?
10 friends, right?
Yeah. Tag 10 friends to get one t-shirt lah. Okay, only the first 10 lah. Only the first 10.
And only you get the t-shirt, not your 10 friends. Huh?
Your 10 friends have to tag another 10 lah, then can. All right. So, guys, I think it's already time is up because we're going to have our Mandarin session. Today we actually have a CEO on the Mandarin session from SLP Resources, right? So after this, you can shift over there. You can listen to the CEO there, and also the comments about the company and so on, and the industry that it serves. So again, if you want to get ready, please, if you have not downloaded our equities tracker platform, please do so. Just contact us at 8408-207-0 through WhatsApp. All right, through WhatsApp. And then you'll be able to pick a few options over there, so you can choose the equities tracker platform. It's going to be free until 30th of April. All right, so this is a good time for you to learn. And when we announce online learning and you have the platform, then you're ready to go. All right.
I think, can I just also announce that this e-learning is not just for value investing, it's also Benny's technical, right? And akan datang crypto as well.
Yeah. So
Yes,
it's
we are
the
learning,
full platform is everything in. 包括了.
Yes.
Yeah, fantastic. So now one last announcement before we go. We have our stock versus properties session tomorrow. Okay, and Faisal Rizwan will be back battling with Alvin. And the last one, because the last week we talked about how the crisis, how investing in properties and stocks in times of crisis. The next session we're going to take a look at the pros and cons. All right. And see which is actually better for you, or maybe both. We do not know. So join us tomorrow in our stocks versus properties final round at 8 p.m. All right. So Alvin, Peter, have anything else to say?
Benny, I think we may have one winner already. I think
okay.
so. My team will need to confirm. Mr. Sean Ha. 1, 2, 3, 4, 5, 6, 7, 8. Yeah, looks like it. Yeah. Okay. So you gotta message us and give us your size, okay? So we can get one out to you. And please, because we're on MCO, not so easy for us to do mailers. Please be patient with us, okay? Don't expect it tomorrow, all right? We might get arrested just going to the post office, all right?
Yeah, fantastic. So just wait for the announcement. We will make an announcement. We'll put on the comments who are the winners, and then we'll get in touch with you. We'll PM you. All right? Anything else, Peter?
No.
All right. So good night, everybody. Thanks for joining us, and we'll see you again tomorrow. Good night.
Thank you. All right.